Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president and financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Thank you for being with us for another episode of Something More with Chris Boyd. I'm here with Jeff Perry. We're both of the AMR team at Wealth Enhancement, and really do appreciate that you tune in regularly. Just want to remind everyone of all the possible ways you can listen and find our podcast. If you're not aware, we are offering the podcast both on video and audio.
Yep.
And so you can find it on YouTube or on our webpage, which you can reach by going to somethingmorewithchrisboyd.com.
I usually listen on Spotify or Amazon. Chris, you're an Apple guy, so it's on the Apple networks. It's wherever you want to listen. If you want to see us, go to YouTube. If you want to hear us, maybe a podcast is better.
Very good. Today we're going to be talking about tax planning before 2026. There's some things to think about, and a lot of these changes that came about with the One Big Beautiful Bill Act can cause you to have some opportunities and things to be tuned into.
Yeah,
might be relevant.
Some old stuff that we should go over every year, and some new things because of the OBBA. But before that, I want to congratulate you and the show for being nominated for a 2005 Luminary Award, specifically in the Thought Leader of the Year category. So
isn't that fun, huh? That's exciting. Love it. Thank you. That's so all the hard work we've done, right? To get this show. Hopefully it's quality content, and we love the fact that we're considered in that category.
Yeah, I think we try to talk about not just things related to our specific business, but incorporate, things that are applied to everyone, like not just like to have an educational component, not just an entertaining component or marketing component. I hope
that's the goal of the show, right? To provide value that people can find from the content as they think about, personal finance and their personal life. So.
Absolutely. We hope that you're a little smarter by listening to us, and bringing up subjects that you may not have thought about. I only listen to things that I feel like I'm better because I listen to it.
Right. And you get glean some new insight. Yeah.
Challenge your preconceived thoughts about a given subject, or learn new things, new topics.
Let's try to do that today.
All right, we'll give it a shot.
All right, and we'll hopefully hear the results of that. I think it's in December, early December. So fingers crossed. We'll see.
Yeah. Well, it's an honor to be nominated.
It's an honor to be nominated. Absolutely. Yep. So anyway, thanks for bringing it up, Jeff.
Yep.
Well, where should we start? You mentioned there was a good Kiplinger article that we can reference, but there's a whole range of things we can talk about beyond that. But where should we start?
Well, the new One Big Beautiful Bill Act is what this article is about. So maybe we'll start with some of the usual things that we think about when we're coming up to the end of the year, and then we can outline some specific things or go back and forth, whatever you'd like to do. I do have one I want to start with, because sometimes it's not talked about in this specific category, but it's super important. Just from avoiding penalties, right? No unforced error is to make sure that you have paid your estimated quarterlies, or
good point.
Or that if something changed in your life, and those, we get those of us who use CPAs we used to get envelopes. We don't need them anymore because you can do it online. But you get
portal or something now.
Yeah, you get a projection of what your quarterly should be. But that does not mean that's what they are, because if life changes significantly, you've got to different job, you lost a job, you retired, you bought and sold a house. You have this year, I think, for maybe people who own mutual funds in a brokerage account, and even if they don't sell anything, it's highly likely that we're going to have some capital gains that we don't expect. And if you did sell things to maybe buy something or, whatever, a gift or something,
throw the numbers off.
Most people's brokerage accounts, capital gains are not withholding taxes unless you ask them to. If you started taking RMDs,
and we don't really have the opportunity in taxable accounts to withhold.
Right. So I think it's a good time to pause. You get some time to figure this out and do some estimating of your own, or call your CPA and say, can you make sure that I'm okay? Because it's not just, well, I'll have to pay a lot in April, which, nobody wants to do either. But if you withhold too much, if you withhold too little, the IRS can penalize you.
And it is worth keeping in mind that if you have yet to take your distribution requirements for people who are subject to a distribution requirement and you've underestimated, you can use that as an opportunity to take more money from your IRA and send it for tax withholding. And that can help to minimize some of those penalties. That could be a little strategy going on there. But, and, Jeff, you talked about the idea of estimated taxes, and that's assuming people remember to look inside the envelope once they walked out of the CPA's office or whatever.
Oh, I have no doubt those envelopes stay in a certain percentage. I won't predict, but more than
exactly.
Never see the light. They never got a postage stamp on them.
On the shelf, forgotten about.
I'm done with that.
Go pull out your tax return. Make sure if you had estimated taxes you were supposed to be doing, pull those out and get them moving. Or possibly look to some of those kind of strategies that could help. I think what's maybe worth keeping in mind is, particularly for retirees, you have a little bit of a window over the next few years where you have some added tax benefits as a consequence of the One Big Beautiful Bill Act. And you can try to strategize. So, for example, if you have an inherited IRA and you have distributions you have to take over the next 5-10 years, whatever it might be, right? Maybe you want to accelerate some of those distributions because you have that additional $6,000 per person if you're married standard deduction benefit. Well, that could be a good incentive to think about taking more income because you've got more deduction to work with.
That's right.
As an example.
And if you're a senior citizen, 65 and older, and meet your income limits, this is even a greater deduction than you used to.
It could be even higher than, So we've got a lot of these kind of one-offs. It's a lot to keep track of when it comes to how these standard deductions are impacted. But this is one of the benefits, is we've had this enhancement in standard deduction, which is already one of the benefits of the Tax Cut and Jobs Act, was that this much higher standard deduction than we had before. Before, we used to have far more inclination to have deductions that are itemized. Now, with the Tax Cut and Jobs Act, and now the extension of that with the OBBA, I don't know if I did enough piece. Anyway, you're better off.
Well, I'm not sure if so. That's with the standard deduction. Something that might be happening this year for people who maybe own two homes or have a lot of property taxes or SALT issues, state and local taxes. That number of $10,000, which you were allowed to deduct before this most recent passage of the bill, has gone up to 40. So there may be people going back
that's a great example too, with where you've got that big SALT deduction benefit. You may want to make use of that differently, because that could really add up for people who have multiple homes, big mortgages, whatever it might be.
talking about the article, that Kiplinger's article, one of the things that they suggested that may be right for some people, depending on when you get your tax bill, if you haven't paid, the suggestion was if you're going to itemize because of this new SALT cap, if you haven't paid your 2025 tax bill, but you receive your 2026 tax bill before the end of the year, which is some people like here in Florida, where I am, we get our next year's tax bill in November. So if I haven't paid mine and I get my 2026, pay them both in the same year.
Kind of bundle it up a little bit.
Bundle it up if you're, especially if this year is going to be a big income year for you. So there's
to try to get you to that $40,000 figure kind of thing.
Yeah, max it out as much as you can. And I know along the same lines about bundling, you've talked about in the past doing something with QCDs or bundling charitable donations.
Yeah, let's distinguish those. So, this is a year-end kind of thinking about tax planning. You do have to make sure that you've dealt with your required minimum distributions. If you are an IRA owner, 73 or older, or if you have a beneficiary IRA that you're required to take a distribution from, rules can be complicated. Get help if you need it.
Yep.
But bottom line is you may be subject to an RMD. And when you're 70 and a half and older, you're eligible to consider a qualified charitable distribution, essentially sending money directly from your IRA or inherited IRA to the charitable intention you might have. Now, it avoids a tax on your end. It's an income tax because the charity doesn't pay taxable income.
Right.
So it satisfies your RMD to the extent that you withdraw that amount. It helps toward your RMD. And that can be a really great win-win-win for everyone involved. And obviously, it's incentivized in our tax code to try to encourage charitable giving from your retirement money. But keep in mind, your IRA type money is all pre-tax. Everything in there for most people is subject to tax. And so if you can have that go somewhere with no tax, well, that's a win for the charitable intention. You get to take that full amount and have it go directly and fully to charity, the amount you choose to donate through this qualified charitable distribution process. Simply a matter of a form from your brokerage or IRA custodian and have it go to the charitable entity. It's preferable to do that before you've taken your RMDs, but we're getting to the point in the year where it's really important to get all those ducks in a row. You got to take your required minimum distribution before the end of the year. And if you're thinking about a qualified charitable distribution, do it soon. So you want to try and do both of those ASAP.
It's a great tactical way to reduce your taxes and achieve your charitable intent. And it may sound a bit complicated if you've never heard about it, but at the end, if you're working with a financial advisor that can help walk you through this, it's really not complicated at all.
It's important to keep in mind, too, that when you talk about the qualified charitable distribution, that is not something that counts in your deductions. It's not a charitable deduction in the sense of you get to itemize that. There was something else you referenced, and I forget now what you had said, but you paired two things and mentioned the qualified charitable distribution of the idea of bundling. So, if you're doing sizable charitable giving, it's a good idea to try to put as much of that into a single year so that you can accumulate that impact, make sure it exceeds the required threshold to benefit from that. It's a good possibility, and you can ultimately maybe do multiple years in a single year, or look toward a donor advised fund to fund as a way to, if you don't want to necessarily not give for years to come, you could bundle a bunch of your gifts into a donor advised fund and then dole it out from there to the charitable interests you have.
I'm sure your church or charity would not mind getting a lump sum in advance.
But they're going to come back next year and be like, "Oh, you did so much last year," so that's why you try to plan that accordingly.
Yeah, well, you might want to tell them you're advancing the money.
Yeah, it is also as we think about some of these benefits we were talking about for particularly for retirees, some of these higher standard deductions. Might be worth thinking about whether a Roth conversion or taking more IRA income is worthy of consideration. Why do we want to think about this? For many retirees, as they age, or the nature of an RMD, a required minimum distribution, is that the percentage gets larger over time. And that very likely means you'll have to take out bigger amounts each year, or at least over your retirement. You'll have more and more income pushing you potentially into higher tax brackets. So, thinking a little strategically about when to take some money from and pay the tax can be advantageous. Doing a Roth conversion could be one way to accomplish that. Could be just I'm taking the money and paying the tax. It's a question of whether you need that money in the near term, or if you don't need it, why not do it as a Roth conversion? Because it stays in this setting where it's free from tax and continues to compound in a tax-free setting, as opposed to if I take it out, pay the tax, and now it's in a taxable environment. I may be tax deferred when it comes to my capital gains, but I'd still eventually have that capital gain if I have it in the Roth. I won't when I take
Right.
it out. So, in any event, however you choose to do it, planning some of that income to receive when you have more deductions and can be helpful to keep you in that lower bracket, and take more money out of that plan that's going to eventually have to come out and potentially push you into a higher income level where you could be facing higher tax brackets. And that's not even accounting for the question of, will tax rates change over time?
Right.
We just, we're saying we had a permanent tax cut with the Tax Cut and Jobs Act. The OBBBA. But will it stay the way it is, or let's face it, in reality, tax law changes over time, so we just don't know when.
Although just one point of clarification, although the tax cut itself was made permanent, a lot of the provisions that we're talking about are not permanent. Some of the things,
that's a good point. The $6,000 bonus, which we talked about, I think at one time was like, was that the one that was the Social Security? They had wanted to have Social Security be tax free, couldn't quite do that the way they would like.
right?
This was the result.
Right.
That goes away at the end of 2028, right?
Right. As does the no taxes on tips and overtime, which is really not no taxes on tips and overtime. It's less
within certain amounts,
income,
right?
Yeah, there's a maximum amount and it is an income limit. So, I 3 years is a long time, but it's not forever. So, to your point, I think one of your points was think about these things now while we have this most favorable tax policy, because some of these things could change. I also want to add something you said about the Roth conversions.
Yeah.
I know from talking to our clients and people that I talk to, a lot of people just look at this issue of should I do a Roth conversion in the current tax year or however they're looking at it as like all or nothing. And that's not the case, right?
Yeah, not at all.
So maybe this year your income is, maybe you're in the 22% bracket, and you've got $50,000 before you go up to the 24% bracket. And if you wanted to stay in that 22% bracket or whatever bracket you're in, bracket creep gets worse the higher you get, but you can just do a partial. You can just do a certain amount to stay within your tax bracket. And if you have a really low income this year, you don't, and you have a lot of money in deferred retirement, maybe this is the year that you do up to whatever tax bracket you're comfortable with. So you can, it's not, am I going to do this big Roth conversion and take the hit all at once? You can do small ones. You can do whatever you feel like doing.
That's a great point. Don't, it's not an all or nothing. So as with most things in investing in personal finance, it's not all or nothing. It's usually a combination of ideas. One of the other things that I think when we were talking about charitable giving, it's important to know that the rules are convoluted and you're best to do some of this strategy in connection with your strategist, your financial planner, your CPA. Do some of this where you can model out a little bit. For example, it appears that sometimes there are income caps on how some of these deductions might work. And, you might want to make sure that before you commit, you're working within the right numbers that you expect. It'll play out the way you expect. One of the things that I did notice is that there's a new above the line deduction for non-itemizers. So if you do some charitable giving, $1,000 or $2,000 if you're married, will be eligible to work toward additional tax benefit for deduction.
There is a income qualification on that as well. So it's a sliding scale. So for example, a married couple, a married couple with adjusted gross income of $100,000 who donate $700 to charity, they're only going to get a $200 deduction as an example.
What was the amount of income in that scenario?
AGI married couple, 100,000 donated 700, so they get 200. It's a scale.
Okay. So it's not as appealing as it sounds.
No,
so
but
keep these things in mind,
if you make the donations anyway, which I think
most people do it because they're doing the charitable intention more than they do it for the tax benefit.
That's right, and I think most of our listeners are donating $1,000 a year, and between their church and their favorite charity, or stuff they do and don't even think about it every day, right?
Yeah, I would think so too. What are some other things that would be relevant to focus on when it comes to year-end planning, in particular as it relates to the new tax legislation?
Well, on the year-end planning, which we do for our clients throughout the year, but maybe people who aren't our clients don't think about this at all, and certainly if they do, it's not usually to the end of the year, is tax loss harvesting. It's one of the things that we do for our clients throughout the year, and especially if there's opportunities to do it. But I wonder, this has been a good year. It's been a good couple of years.
Yeah, so it's probably hard to find some of those tax losses to harvest.
Yeah, exactly.
Where you're going with that, yeah.
And I know we spend a lot of time doing this next thing for our clients as well, about just talking about tax efficiency, what you have and what type of accounts, and how you withdraw from what type of accounts. So, there's a lot of reasons to work with a financial advisor, but some of these things that, don't get people's attention, like sequencing of withdrawals, or, having investments that are efficient in the right place, and investments that maybe generate a lot of capital gains or dividend or interest income in the right place. People leave a lot of money on the table because they either don't know about this or they don't have the time to.
Just real quickly, Jeff, explain what you mean, because I know what you're referring to, but it might be unclear to someone who says, what do you mean the right place?
Yeah, so I'll give you an example that relates to something that I said earlier about people may have some capital gains this year, even if they didn't have a sale, right? So certain types of mutual funds, all mutual funds kick off capital gains and income distributions to their shareholders, usually annually, many times in the beginning of December before everybody closes their books.
Year end, yeah.
That's right. And when we have some really strong years, which we've had, these are significant.
Accumulated, yeah.
That's right. And so if there's a lot of and if you have a mutual fund that has a high degree of turnover, a lot of sales, lots of repositioning, a lot of rebalancing, when they do that, they're creating capital gains, and these get distributed to the shareholder, which are taxable if they're in a regular brokerage account. So, for a long time, mutual funds were the only option, or one of the primary options that people had to hold if they wanted to invest in a certain fund area, sector, whatever.
Yeah.
But we've learned and been more aggressive maybe than some, that there's ways to own those types of investments, typically ETFs, that are much more tax efficient than owning a mutual fund.
Aggressive in the sense that we've been very active in making some transition from these mutual funds that are inefficient.
Yeah, aggressive might not be the right word.
Just for clarification. Yeah, and to this point, the setup you gave, I would just add, in a year when there's a downturn,
it hurts more.
After all of these good years, that's when you really tend to see these distributions get kicked out and can be painful tax-wise when you own a mutual fund in a year that the market's gone down, and then you get hit with some of these distributions of tax burden. So because the mutual fund had to generate liquidity for leaving shareholders.
Redemptions, right.
Yeah.
And it hurts more. If you have a good year, no one likes to pay taxes, I don't think. But if you have a really good year and your mutual fund,
you can live with it, right? Yeah.
I made a gain. I got to pay the piper. But if you have a bad year and your account's lower, and then you get a tax bill,
get whacked with a tax bill.
How is that possible? I guess the overriding point is.
So you were talking about location of some of these kind of holdings.
And then as far as sequencing of withdrawals, say from a IRA, the taxable IRA, for example, a traditional IRA, and this topic is related to RMDs also. We'll talk about RMDs for a second. Sometimes it makes more sense if you're going to have large RMDs that might push you into higher tax brackets. It might make sense to start your withdrawals before your RMDs if you need money, if you're in a lower tax bracket, right?
Mm-hmm. Mm-hmm.
It makes sense to consider when to use your Roth IRA funds if you have a Roth in conjunction with money that you need. And it certainly makes good sense to evaluate if you have taxable income, say money in a brokerage account.
Yeah.
When do you use that as part of your withdrawal strategy? I think a lot of people who have brokerage accounts and IRAs and maybe Roth IRAs, they have all three, which is great.
Yeah, we want that kind of tax diversification if you're able to. Yeah.
Yeah, but I think many people say, I need some money for income from my retirement, and they say, okay, what do I take it from? Oh, I'll take it from my IRA, my traditional IRA, which used to be my 401k, which is my retirement money, and they neglect considering using some of the funds from a brokerage account, where in many cases the tax liability from a withdrawal or a sale in a brokerage account, although taxable, will be at a lower rate because it's primarily
it's not all taxable. Number one,
that's right.
It's some of it is principal, and two, capital gains rates are lower than income tax rates.
That's right.
Yeah, and I think your point too about those kind of holdings that you might own that have some of these capital gains distributions or income that it might kick out. Placement of these where you put more emphasis can be relevant in some accounts for tax strategy. Mm-hmm. It can be reasonable to think about, where do I want to hold what kinds of investments? Now, sometimes there's different reasons to prioritize.
Right.
Sometimes it's, hey, I want the liquidity, I want the access. I don't want to have to pay a tax to get at my money. Mm-hmm. But sometimes if you have your fixed income in an IRA and you're not spending it all, well, at least it's in the IRA. You only take what you want to spend, mm-hmm. and that income is going to pay income tax anyway. Whether if you were going to have it outside the IRA and receive it, or if you had it inside the IRA and withdraw it, it's the same income, right? But at least if there's excess, you can leave it in the IRA, as an example, or where you have your growth accumulated, capital gains expectation, where you do. There's reasons to think about these strategies. But there's layers of reasons. Sometimes it's a focus on liquidity. Sometimes it's a focus on tax strategy. And depending on circumstances, can make sense as to, what do I prioritize?
Right. And this is, we're talking about a lot of issues, but these these things that the common, non-financial person, they don't think about, they don't know about. And these are the things that when you're working with an advisor who knows you and knows your complete picture, and you meet with them, these are the things that they should be talking to you about, because these are worth money. These are like added values. These aren't just many people go to a financial advisor because they want help with their
portfolios,
investing,
investment
right?
decisions.
Right.
Yeah.
But in my view, a good financial advisor earns their keep, not just by having a good asset allocation, diversity,
good investment returns.
That's right. All those things, rebalancing, all those things that most do. But these things really add significant value to you as a person and your tax bill and your future success of your plan.
Yeah, it's a really good point. Those added decisions can really add value, and things that we don't necessarily quantify as readily as we do. Oh, what's my rate of return?
Right.
One of the things that came up recently, and I'll throw into this conversation, was a client was asking about what's my availability to contribute to my retirement account, how much, and they weren't really aware of the extent to which they could be doing catch-up provisions.
They were over 50.
And they were over 50. And in this case, they were in that window where there was that extra in your 60s. And so they were like, oh my gosh, they hadn't been doing the 50s and they had this extra. So they were taking some of their income at year end and just plowing it into the plan.
Yeah, and you can do that. Like, you have, in this case, 2 months to go. If you have excess room in your ability to contribute, we'd probably prefer that you planned it throughout the year. But
sure, if you didn't have that done and you still have a window, take advantage of it. And again, if you have the cash flow, you can comfortably do that. But I was really happy that they were thinking that way, trying to maximize the benefit of it. And it doesn't have to even all be traditional. It could be Roth, could be whatever. The virtue is just try to get that money, some manner of tax benefit that you get from a retirement plan. Maximize that.
Yeah, this brings up a conversation I had with a client a couple days ago, and he was under the impression that there was a maximum amount. I think he thought it was 15% that he could withdraw from a paycheck. And I said, no. You can take half of your paycheck if you can afford it.
Yeah.
To get to that maximum allowable contribution for this calendar year. So if you have the cash flow and you haven't reached the limit, that's a way to reduce this year's taxes and, quite frankly, put more away for your future.
Yeah. So that's the kind of thing, as we have a little window of time now, make sure you've done what you would like to do. Similarly, if you have an HSA, you can contribute there as well. Some good tax benefit. Again, remember, an HSA has the benefit of money going in pre-tax. And if it's in the plan, it's growing without tax. And if you spend it on healthcare related expenses, it comes out without a tax.
Yeah.
So, wow,
the only one that gets all three.
That's better than a Roth, even, right? So take advantage of that if you have that option through your work place of employment, and then really consider: do I want to spend that now or spend it in retirement? Might be worth pushing that off. There was a lot of other things, Jeff, and I'm kind of there's so much to cover. Was there anything that was like other things that you were thinking, oh, we really should have talked about?
No,
this article was a good article. We'll have to include it in the show notes.
Yep, it's a very long article too for Kiplinger's article. The only thing I think we didn't cover, we kind of glazed over some of the things, but the only thing I think we didn't cover at all, and so if you're interested in these subjects, click the link and read it. It has to do with parents. There's increases in the child tax credit. There's the Trump account for
babies, new accounts,
babies born this year, or the time frame there. You should double check with a free $1,000, if you will. And there is favorable changes to 529s that make it just that much more favorable and
vehicle to utilize.
Yeah,
because you can access it more readily than you would have previously.
That's right. And if there's money left over, you can ultimately, maybe over a period of years, but you can ultimately transfer the money to a Roth IRA in the name of the recipient. If you're a parent and you're saving for college, or you just had a baby, or you're thinking about your taxes, there's things this year, and not permanent, but this year, that you might be able to take advantage of in there at the end of that article, which we'll put in the show notes.
So much to think about and so little time to do it. We've got 2 months, a little less, and get right on these issues. But if you need help thinking it through, this is how a financial advisor can add value to what you do.
Right.
It might be worth talking to someone. We're happy to be that someone. If you'd like to have a complimentary consultation, don't hesitate to reach out to us. Thanks for being with us for this show. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll-free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.